Hey guys, how are you? Time for a trade review. Today was a very interesting trading morning here. I'm ending the morning red because I made some mechanical errors from not protecting some profitable trades. Although I had 3 winning trades to start and I managed to end the day down 7% because of some scalps that went wrong. And yeah, so let's get right into it here. Generally, SPY and the market was gapping up extremely today. And looking at the NASDAQ, there were a few levels that I was watching going into this morning, okay? One of them was in fact up here. Now ignore everything that just happened. Was up here. As you can see how we moved up and then we kind of tried to lose the hourly trend and then we actually lost it the second time. So I said, okay, that level for me was going to be a key area because if we regained it, it would have meant that shorts would be trapped and we'd probably likely move higher. And that happens a lot. I always look for that pattern where we have a level that gets tested twice and then gets lost and then regained. And that right there is an example of a failure. And I look for that pattern all the time. And that's been happening a lot, to be honest. That's why I look for it. And we had a sell-off today, and the NASDAQ was leading the way on the sell-off. In fact, a lot of tech sector names, still, if I do a scroll through, you can see Microsoft's just now confirming a 5-minute trend change. And a lot of these names were very bearish this morning. Facebook too. Generally, I got to take advantage of some of the downside moves in the morning, like I'm sure a lot of people did. But I managed to get trapped in some calls afterwards, and I was looking to scalp some calls thinking that we're going to see a little bit more upside, but these sellers defended these offers over here really, really well, and they did a good job at making it look strong and then dumping it all in one shot. All right. Financial sector definitely leading the way today as a bull, whereas the healthcare sector was in a bit of a trading range. NASDAQ leading the way for the sell-off, okay? Take a look at XLF here. You can see that beautiful bull trend, just healthy consolidation at this point. XLV just kind of a drop in the morning and then healthy consolidation. We tried to lose the support a couple of times, but we're still kind of chopping. So now we're in bullish territory. And earlier we were as well, except that the NASDAQ just couldn't stop selling off, all right? So we had some pretty aggressive sells here. We had 2 legs down, then a retrace for a 5-minute lower high, then another leg down, another retrace for a 5-minute lower high, and then we had the massive sell-off, which caught everybody off guard, most likely because people are trying to buy these dips, because we normally don't see more than 3 legs down in the morning session, but today was an exception because obviously we're gapping up. It's a bit different, a lot of profit taking. The higher we go, the more bullish the crowd gets, and that means that these smart money ones are going to be selling into that, and then, you know, that's the rest of it. So let's go over the trades here to start here. I started with some puts here. I started scaling into the 5-minute lower high after the initial drop. Got into these puts and I was looking to scale in a little more, but I missed it. I missed the fill. Again, it's tricky. I'm trying to perfect my system right now where I'm scaling in on the bids at as long as a certain price is holding. And then I want to be scaling out on the offers, right? So I managed to get out of that trade for a profit. Then I did the same thing again. So you can see I bought it at 73, sold it at 84. Then I did it again. I bought it at 86, sold it at $1.03. And in the meantime, I actually had an order in to sell the 300 puts as a credit spread. And I got filled on that. I actually forgot that I had the order in, but I got filled on it. And I ended up being short the 300 puts, which worked out pretty well. But I made the mistake of not protecting that trade when it was in profit. I didn't put in the break-even stop. I didn't put in a conditional order. And we're going to talk about this. And it's so hard, guys, because, you know, you're not a machine, right? So when you're looking at the markets, you're thinking, what's more likely? Yes, this is more likely. But at the same time, I would like to probably see a little bit more profit from this trade, right? So it's so easy to forget to be mechanical. It's so easy. And it's also really, really easy to act impulsively and to put on trades impulsively, to just kind of buy market call option or buy market put option, you know? It's just so easy. When you have these things at your fingertips, it becomes literally so easy to just get in impulsively on any trade. That's something you need to learn how to control. All right, guys. So you can see I had some scalps on these calls here, these 304 calls, and I got ripped apart on these calls, okay? I scaled in and there was, I think one of these entries, at least a few of these entries were impulsive buys, and then I would scale in on the bid afterwards. But really, the initial entry should be scale in on the bid and then selling on those offers. Again, just getting caught in some of these bad trades with the calls, not protecting. And then I finally made a decision to protect the trades, and I actually put in conditional orders on the rest of my long positions. And I said, if SPY trades lower than this price, then sell or buy back contracts, market, I'm out of the long positions, right? So I think that, in my opinion, that should be a daily practice. That should be one of the most important things in your trading style. The more information the market gives you, you need to be looking to protect your winning trades and looking to potentially reverse trades or hedge trades if certain things happen, if certain price points are breached. Okay, and again, this gets back to understanding stop placement, understanding liquidity. Where is there likely to be trapped liquidity or not? Okay, and the reason I don't mind sharing all of this stuff with you guys, because it's going to take you to study it to be able to do it anyways, right? So I don't really care if I'm sharing all this stuff. By the way, some people charge you thousands of dollars to tell you about this kind of stuff, but I'm just putting it on YouTube for free. So essentially I'm devaluing all of their courses, but I don't really care because you're basically paying them so that you can go into the market and learn yourself anyways. So might as well show you. All right, guys, so let's get into it here. 1 minute chart on the spiders. After this initial drop, I missed the 2 legs down. We had a massive pop after that, and I was looking to potentially scale into a 5 minute lower high here. I got in right at the 12 exponential moving average because I was expecting us to see a bit more of a sell-off. So as soon as I got in, price kept going up. So I said, okay, I'm willing to give this trade a little bit more breathing room. So I said maximum stop loss 301.70 75. All right. So you can see that we topped out around that general area. So I didn't get stopped out of the trade. Actually, I would have been wanting to scale in a little bit more to that as we were holding that. So next time I'm going to do something similar to that. I'm going to set up in a way where I'm getting into a trade, anticipating that something is likely to happen, but also scaling into the trade on the bids, still anticipating that that thing is more likely to happen, right? So basically the example is, instead of impulsively entering a trade, you want to be trying to get those patient fills, all right? So I got in here, I got out here for profits. Then I did it again second time, and then I got in, I believe, somewhere near the bottom of this candle. On this candle, I actually got filled on selling those 300 puts, and then I bought back the put right there. So I'm short the 300 puts now as a credit spread, and I just had 2 successful short scalps. So I'm watching what's going to happen. So the 26-minute time frame for me, this was the level to watch. So you can see we came down, tested it, lost it, regained it, lost it, regained it. 3006. So the equivalent level that I was just telling you there, 3006, on the SPY, it would have been around 300 and a half, so 350. As we moved down here, I was watching these bids and we held them pretty nicely, okay? We resulted in a nice rally up to 301.50. I'm green on that trade, and I didn't protect it. I didn't do anything. I was anticipating that we were going to potentially push above that resistance that I was calling out earlier, or that 301.75. Especially here, I was anticipating that was going to happen, because you can see how this sideways consolidation looks like it could just pop at any moment and squeeze those shorts out. But really, what I think they were doing is they were defending this resistance because their stop losses were essentially going to be above here. I did not protect the trade at any moment during this. And ideally, what I wanted to be doing was this. So whatever contract, let's say I'm long this contract right here, I'm going to say sell market, whatever my position is, and then I'll right click on the order, attach or modify conditional, and then I will choose price, the underlying, which would be SPY, trading below whatever price that I'm saying, okay? So that means that that order will only trigger when SPY trades at that price. And this will work for futures contracts, options contracts, anything essentially. And that is what you want to be doing essentially to protect your options trades from getting destroyed, because we know that in this kind of market, that all it takes is one big wise guy to come through and start sweeping the order book in either direction, and then all of a sudden your puts or your calls are way where you didn't expect them to be, okay? So I got long some calls here, anticipating that we were going to see a held bids, and then we started to see this kind of stuff, and this kind of stuff kept me confident. You can see how we're seeing lower wicks, right? And it's likely that we're going to keep pushing because the bids are keep on holding 4 times and everything. XLF very strong. And then we started to sell off. Once the NASDAQ started to really sell off, that caught me off guard, of course, because I didn't have any protective orders. So all of a sudden, the puts I sold, the 300 puts I sold at 55 are now, we're at like 20, and now they're heading back to 55. So what do? I should be covering them, right? So we had a massive drop. And you know, it's hard because when this stuff is happening, if you don't have protective orders in the market, you're watching what's happening and you're going to panic, right? You're saying, well, okay, what do? Do I wait for it? Do I not wait for it, right? It's decision making in the moment. And that's why day trading is probably the hardest form of trading, but also the most rewarding form of trading if you're able to nail it. So generally I got wrecked. I would have bought another call here, and then I would have sold these calls here for a loss when I realized, okay, it's very unlikely at this point, based on this drop, we just lost all this liquidity from 301. It's likely SPY hitting the low of the day, NASDAQ breaking the low of the day, kind of in free fall. it's becoming more likely that we see another sell-off. So I got rid of the calls there because I got long these calls again here. As soon as we held this bid, I'll show you that. You can see 11.33. I got long again. And this time I had managed risk though, okay? So I said, I'm gonna get long the calls again for another attempt at 11.33. And this time I put in a conditional order. I said, you will sell these contracts for market if SPY trades below 324, okay? And that was not an arbitrary price I made up. I wanted to go below the low of the day enough that if we were to sell to that point, it would become more likely that we would sell more, and not high enough that we could see a bear break by like 5-6 pennies and then straight into a bull break, right? So that's the trick about stop placements. I placed a conditional order to buy back my short 300 puts and to sell these long calls that I had bought here for a scalp if SPY were to trade below 324. And what happened was all those orders got triggered right here, and I got out of all of my long positions, and I was still long a certain put option, and then I managed to buy them back here. And that's pretty much it. So I'm ending the day slightly red because of the fact that I didn't mechanically protect my profits on my short put trade, and I also didn't mechanically protect my call trade, okay? Because these drops happened extremely fast, too fast for me to react. And that's why your risk needs to always be predefined. I'll just give you that example of the call trade, okay? So actually I was thinking of getting long calls at this point. I missed the trade. You can see how we moved down below 390. We regained it. That right there was a good entry for a long scalp, at least to test somewhere near these highs, okay? I missed that one. We had a massive pop. That would have been a great area to get out. Pull back, and you can see how we're chopping. At this point, the long scalp is still relevant, although potentially less likely, especially if these offers are gonna hold. So if you're gonna take a long scalp here, your stop needs to be below 301 or the previous level, which was 390. So what I had to do was, when I got long these contracts, I had to be putting in that conditional order to get out of these contracts when SPY trades below 390 or 389, whatever you choose, right? So look at what happened. We had the huge sweep of liquidity once this dropped. So perfect bull flag, held bid, held bid, held bid, drop it. We swept all of that liquidity, all right? So that's why you need to pick your stops very carefully. The level that we lost and regained, that was a good area to place a stop. And everybody placed their stops there. They got murdered. And then we just sell. That would have been the area to get short if you were planning on selling a further bear break. And if you would have sold there, you would have caught a move down to the low of the day, which would have been another great short scalp, okay? So this is kind of what I'm working on here, guys. It might be a little advanced to understand this stuff if you're very new to trading, but that's pretty much it. All right, guys, so I wish you a great day, and we'll be back tomorrow. So I'll see you guys tomorrow. Have a nice day. Take care.